Hello, and welcome to One-to-One Mining Investment APAC Online. Today, we have Alex G. of CRU here to talk about the outlook for the nickel market and the impact that COVID-19 has had on the industry.
Hello, everyone. Thanks for being here with me for this session on nickel market. So today I will discuss our latest idea for nickel market during this special period, and I will also go through with you about some new approaches to prepare for the opportunities and potential risks coming with the post-pandemic era. Our presentation is consist of 3 sections. The first is recent development in nickel market and prices. But more importantly, we'll do a broader review on the exact impact from COVID-19 on different macros that will potentially affect metals and mining sectors. Then we will come to our scenario-based approach to forecast the post-pandemic situation with 3 scenarios created by our consulting team. Our base case for nickel, we expect economy to see some significant decline before recover from late 2020. We forecast nickel demand to decline 7% year-on-year for 2020. Downside risk remains in various returns and the losses in economy due to the extended lockdown. Metals demand will follow tightly with the industrial activities. As we can see, the global supply will also decline too. This is mainly affected by disruptions. One of the largest disruptions has been the Philippine ore supply. Currently, only mines in Tawi-Tawi and Palawan are shipping ore, with most others having suspended operations. As we see in the chart above, social distancing measures are not the only reason for supply cut. Lower prices also remove some producers from the higher end of the cost curve from market. If the economy continues weighing, we probably will see more mining entities experience worse balance sheet too. In addition, ongoing construction of new lines in Indonesia has also been delayed, which will affect our forecast of new supply timeline in 2020 and 2021. We see our supply in next 2 years will also be impacted. Despite lower supply, the losses in supply is not as much as losses in demand. We will still see a surplus to come. In this chart of relationship between market balance and the nickel prices, we can see a clear correlation between the two. We expect a 100,000 tons surplus in the market for this year, which indicates a downside pressure on prices. On the other hand, more ferronickel suppliers sitting on the higher end of the cost curve will have to leave the market if the prices go below $11,000 per ton, which will provide some support to prices. So our estimate for price this year on average is around $12,300 per ton. And the prices will recover to around the level in 2018 next year to a level about 30,000 on a narrowing surplus and rising operational costs. However, high uncertainty in current situation raises need for scenario analysis. This is typically high and low cases scenarios we do under current circumstances. As you see in the high case, we expect a V-shaped recovery and nickel prices above 14,000. And the low cases where the second wave of infections come and the supplier doesn't respond quickly enough, which leads to production with negative margin. However, we identify some exception too. While ICE will see severe decline in future, EV sales will be robust in every scenario, which we also include in our scenario studies. Policy changes, subsidies, as well as new car model come, and change in purchasing habit will all contribute to this section. This is an example of importance of an internal consistent analysis, which does not apply homogeneous adjustment without delving into the industry dynamics. And this lead us to the section 2. Our discussion on nickel market apply quite a lot macro assumptions in terms of forecasting with uncertainty. Our classic model for current situation is types of recessions. There are two factors which help us to differentiate the three types of recession: whether there is a permanent loss in the level of output and a permanent fall in the growth rate of output. The factor 1 happens when missing spending during the downturn is not fully made up during the recovery phase. A good example is a permanent loss in output level is when a haircut missed in March is unlikely to be followed by 2 haircuts in April. In that sense, some expenditure is lost permanently. The factor 2 means if the economy sees a permanent loss in its level of output, but can return to its pre-crisis growth rate in the midterm, it will be called a U-shaped recession. To continue with the example above, this occurs when the missed spending is not made up, but will continue at the usual frequency once the pandemic is behind us. So in this model, we can see our forecast is primarily derived from our pre-pandemic basis. We examined each country's historic economic performance and the social structures individually and generate our analysis. However, there's issues with this method. Of course, it's tempting to think upcoming commodity cycle in terms of different parts back to the market condition existing just prior to the shock. For example, the forecast based on VUL shaped recoveries. Two risks exist in this forecast model. The one is structural change on fundamentals. What we saw for structural change in metals market following the early 1990s recession is an example. Significant shocks can fundamentally change patterns of demand and supply, including longer-term technology adoption, competitiveness, and market structure. Secondly, it is also important to consider the role of government and public policy during this period, which have potentially very big impacts on commodity demand. For example, just a week ago, China has set out its major economic objectives and policy goals for 2020 at the National People's Congress. No growth target is set, but a physical stimulus of 6% of nominal GDP is announced. Compared to previous stimulus, I would like to raise a question for our audience today. What's the difference between today's stimulus and the one in 2008? In addition to those two risks, we also see the diversity of micro impacts in past global recessions. For example, the 2008 crisis caused a deep drop in GDP relatively to previous cycles. However, the intensity of mineral use rebounded more rapidly, in part due to having counter-cyclical infrastructure spending. Or for example, like 2015 down cycle, where capital spending has been slower to recover relative to previous contractions, which means supply side were hit, while demand side saw more modest impacts, particularly in base metals. If we look back to think about the scale, and the impact of the 2008 Chinese stimulus package. Those who follow the initial destocking in react to demand destruction fear to identify opportunities from the Chinese policy response, resulting in delayed and inefficient investment. By contrast, those who act early on the counter-cynically are often rewarded, such as those who bought assets when the industry was depressed in the mid-2000s, prior to the China boom. So ensuring a strategic and objective focus on the end state of prices, rather than a return to the past, means avoiding herd behavior, or we say groupthink. This led us to our final session, rethinking the cycle from a scenario-based approach. Consider the factors that shape the impact of COVID-19. We come up with 3 scenario narratives, which is shown in the top. These factors we consider are mainly 3 aspects: the extent of underlying contagion risk, the scale and timeliness of policy interventions, as well as the associated behavior and investment response of households and firms. The first one is our most optimistic scenario. In this scenario, economic and social business as usual resumes relatively quickly, despite modest economic headwinds. Growth in immunity and limited health risk enable swift and permanent relaxation of social distancing and wider support policies. The economy rebounds, supported by sustained public investment programs and the return of consumer and investor confidence and associated activity indicators. Public and private balance sheet will significantly weakened, gradually recover without exposure to other major shocks. So a more pessimistic scenario is called disordered adjustments. The main difference from the first scenario is there's less functional international relationship and less coordinated policies. We expect more political and social tensions across and within the societies. As we see in news today, the constant dispute and trade actions between Beijing and DC. A lack of consumer and investor confidence is expected, given a more volatile dynamic. The third scenario assumes a world of fundamental change, managed adaptation to the new normal. In this case, we assume persistent contagion risk from waves of pandemic and the structural shifts in demand and supply with weaker demand in consumer and investment goods, as well as a heavier physical burdens. This means the structure of economy can be very different from pre-pandemic time, that some basic assumptions in traditional economic recovery may be invalid, and a more consistent analysis into factors that will be needed to using forecast methods and mining from a broader perspective. So to conclude, we talk about our forecast on nickel markets in our first half presentation. We expect 100,000 ton surplus is expected, which will put downward pressure to prices. Our cost curve shows the support point for prices. Combine the 2 factors, we derive the average price at around $12 and $300 per ton. We also discuss about 2 risks in traditional forecast model. not saying it's wrong, as well as the diversity in macro impacts on the metals market. And last, we discussed about 3 scenarios we have come up with in order to avoid those risks. And in the last 2 scenarios, we see the possibilities of a new normal after 2020. So last but not least, I would like to thank you all participating in this session with me. And you are more than welcome to reach me via email or Skype for Business to discuss today's topic. I hope everyone stays safe and stay positive for the time being.